Hello everyone, today we will be completing the entire IGCSE Enterprise syllabus for paper 1. Okay, so there are basically 10 main chapters in IGCSE Enterprise. These are the first 6 on screen and these are the last 4. So let's begin. So, Introduction to Enterprise. What is enterprise? Enterprise is just another word for business. You will not necessarily be asked the direct definition of enterprise in the exam paper, but this is just as a reminder. Now, what is an entrepreneur? This is a common question that comes up, and I've written the exact definition that you will need to answer this question and get you those 2 marks. So, an entrepreneur is an individual who organizes, manages, and takes risks in starting and running a business to achieve profit. Now, the main word here is takes risks. It is important for you to mention risks whenever a question asks about entrepreneurs or qualities of an entrepreneur. This is something that the examiner wants to see. So what is enterprise capability? This mostly comes in section A of your question paper, but whenever they specify enterprise capability, you must answer within these 4 subheadings that you're seeing. So enterprise capability is basically just the quality that an entrepreneur must have to actually be able to run an enterprise. Now let's debrief these 4 enterprise capabilities. Number 1 is being innovative, which means basically just coming up with new ideas, methods, products, and basically finding out new and unique ways to solve a problem or just create something new that was needed. Number 2 is taking and managing risks. This is one of the most important enterprise capabilities that an entrepreneur must have. We will go deeper into taking and managing risks more than the other 3 because risks on its own is a very deep chapter that is covered separately and is questioned a lot in the exam. So taking and managing risks is exactly what it sounds like. It's basically making a decision based on information that's already available to you or that you have to take out, and making a decision based on the information and based on what seems to be the right thing to do. And obviously, it's for a positive outcome. So the decision is usually in a percentage, like 90% chance of success and 10% chance of loss. So obviously that seems like a risk worth taking because of how high the success factor is. Number 3 is being creative, which just means to think outside the box and generate either original ideas or build off of ideas that were already there. And being creative is generally very useful and very necessary to drive a business forward. Number 4 is a positive attitude, maintaining optimism and a can-do approach, which helps overcome challenges, motivates others in a business environment. Now, all of these on their own sound exactly like what they are, so it's not very hard to memorize this. You just have to remember the heading of each one and build off of that based on what the question in the exam paper is asking you. Next are the types of enterprises. There are mainly 2 types of enterprises, a business enterprise and a social enterprise, and these are also exactly what they sound like. The main aim of a business enterprise is to generate profit, maximize growth, and basically what a general business looks like. And a social enterprise's main aim is to provide environmental and humanitarian relief, basically just a social cause. So anything that's going to benefit the community, benefit society, or just help humans or animals. All right, next is stakeholders. This is also a very important topic and honestly also something that's very easy to learn. So what are stakeholders? Stakeholders are people that are just affected by an enterprise. So there are 2 types of stakeholders, as you can see on the right, an internal stakeholder and an external stakeholder. An internal stakeholder is a person or organization that is directly affected by the company, whereas an external stakeholder is a company or a person that is indirectly affected by the business. So internal stakeholders include employees, managers, whereas external stakeholders would be customers and competitors. Next is ways of enterprising. This also usually comes in section A of your question paper, but has come up in section B before as well. So you have to know how to enterprise in 2 places only, at your home or at school. This table is up here, you can read it. I don't want to go into details, but basically on the left are the methods, and on the right where it says application at home and application at school is how you're going to use the method at your home or at your school. The methods that I've listed here are the only ones that you really have to know and are the key ones that you can use in your answers to secure your marks. Now this unit has 2 main themes: how to start and run an enterprise, and what types of businesses you can be involved in and or start. Now this is the enterprising process. So every business starts with a problem or a need. So the first step is identifying the problem or want. This is one of the most important steps that determine the likelihood of success of your enterprise. Because if you're solving a problem that isn't very common or only you have, you won't be able to sell your product or service. But if you're solving a problem or delivering on a want that is popular, you are more likely to gain the attraction of more customers. So that's why identifying a problem or a want that you want to deliver on is very important and definitely related to the success of your business. Number 2 is exploring creative solutions. Once you've identified the problem or want, you're going to find out different ways where you can deliver on it, meaning creating prototypes or just branching out into various fields and finding out ways to solve the problem. Number 3 is action planning. This is where you plan everything out. So the timeline, the people involved, and basically the step-by-step process of your objectives to achieve your aims and goals for the business itself. Number 5 is monitoring your progress. This is where you see if your business is actually working. Are your customers actually happy? Are you staying within the budget? Are you following the plan? You basically track all of this in order to find out exactly where you stand in terms of your enterprise. And finally, number 6, evaluation of success and failures. So this is where you take a step back once things have been running for a while, and you basically evaluate on how everything has been going, what went well, what didn't, and basically what you can do to improve. Questions related to the enterprise process are very common in both Section A and Section B. So it is important to apply this exact methodology when you're working on your enterprise project so that if you're questioned on one or more of these steps, you're able to answer with your own experience accordingly. Next are the types of businesses. I want you to remember how in the last video we talked about the 2 types of enterprises, the business enterprise and social enterprise. Well, these can be further classified into the types of organizations that there are. Number 1 is the sole trader. This is the simplest type of business. You're the only owner, you make all the decisions, it's easy to set up, you keep all the profits, and you have full control. But you also take on all the risk by yourself. So if the business gets into debt, that debt is yours. Your car, your savings, they could all be used to pay it off. Sole traders are also an unincorporated business, which means that the business is not a separate legal entity from the owner. So if the owner dies, the business stops immediately, and all assets of the business belong to the owner. So while it's simple and cheap to run, there's a high level of personal risk involved. Next are partnerships. These are businesses owned by 2 or more people. You share the workload, you share the ideas, and you share the profits. It's still quite easy to set up, and it can help to have more brains, more hands involved, but partners also share the risks and the liability. If one person makes a bad financial decision, the others can still be held responsible. And of course, since there is more than one decision-making body, this could lead to a lot of disagreements and disputes. Moreover, a partnership, just like a sole trader, has unlimited liability, which means that the shareholders involved are personally responsible for the company's debts or financial losses. Next is a limited company. This one's a bit more formal. The business becomes a separate legal entity, which means the company takes the financial hit, not you personally. So if something goes wrong, your personal assets are protected. There are 2 types of limited companies. One is a private limited company, and the other is a public limited company. Private limited companies are usually small or medium-sized businesses, whereas public limited companies are large and are listed on the stock market. Now, a limited company is an enterprise where the shares are openly sold. In a private limited company, the shares are usually sold to family and friends, whereas the shares of a public limited company are open to everyone. The trade-off here is that it's more complicated to set up. There are legal requirements, annual reports, taxes, and just because you started the company doesn't mean that it's always going to remain in your control. You could lose control over your own company because of other shareholders. Number 4 are cooperatives. A co-op is a business owned and run by its members. These could be the workers, the customers, or the producers. The idea is shared ownership, shared decision-making, and shared benefits. The 3 types of cooperatives are consumer cooperatives, worker cooperatives, and producer cooperatives. A consumer cooperative business is owned and operated by its customers. The consumers pool their resources to buy goods or services in bulk, which help reduce the costs and ensure fair prices. Profits are usually shared among the members or reinvested to benefit them. Worker cooperative businesses are owned and managed by the employees. Workers make decisions demographically, they share profits, and have control over how the business is run. A producer cooperative is a group of producers, like farmers and small manufacturers, who join together to process, market, or sell their products collectively. By working as a group, they can gain better market access, lower costs, and receive fairer prices for their goods. Co-ops are great if you want a democratic structure where everyone has a say. They often also focus more on benefiting the community and fairness than pure profit. The downside is that the decision-making can be slower because everyone needs to agree, and raising capital can be harder compared to a limited company. Number 5 are franchises. This is when you buy the right to run a branch of an existing business. Think of fast food chains like McDonald's or Subway. Those are franchises. You get a proven business model, a strong brand, and often a customer base already familiar with your product. You also get support from the franchisor like training, advertising, supply chains, but franchises also come with rules. You're limited in how much control you have to follow the brand's systems, plus the setup costs can be high, and you'll usually have to pay the ongoing fees. A franchise is an unincorporated business, so the franchisee is an independent business entity. Now, the last type of business is a social enterprise, so charities or not-for-profit organizations. A business that operates for social, environmental, or charitable purposes rather than profit is a social enterprise. Charities and not-for-profits usually record a surplus rather than a profit. Now, these, just like co-ops, can be unincorporated or incorporated. Social enterprises can be run like regular businesses, but they focus on the people or the planet. They can also get access to grants and donations and often have tax advantages, which means there are certain types of taxes that they won't even have to pay. The challenge is that they're often limited in how much profit they can make or keep, and growth can be hard if you rely on outside funding. So those are the 6 types of businesses. I've listed them here in a neat table format so that they're easy to come back to, since most of the information is in one page. Enterprise skills. This is a relatively short topic, so let's just get right into it. Okay, so when you first see these 16 subheadings, don't get scared because these aren't separate topics. These are just enterprising skills that an entrepreneur must have and a list that the syllabus has given you. The most important thing is that you don't confuse enterprising skills with enterprising capabilities. Now, enterprising capability is something that we covered in Unit 1 and is completely different to enterprise skills. If a question asks about the enterprise capabilities, you have to mention one of the 4 enterprise capabilities that we mentioned in Part 1. And if the question asks about enterprise skills, then you have to mention one of these 16 skills. Sometimes the question is already going to give you 2 or 3 skills, and you have to write how you applied those in your enterprise project. These 16 skills are basically the parameters that the syllabus has given you. So when they ask about enterprising skills, you have to mention one of these 16 skills. Now let's quickly go over these and discuss what each of them mean. Number 1 is the practical skills and knowledge to create products and services. This is the ability to apply skills and knowledge to develop and deliver products or services. Number 2, leadership, which is the ability to guide and inspire others to achieve a common goal. Number 3 is influencing skills, the ability to persuade and affect others' decisions or actions. Number 4 is team building, the process of developing a group into a cohesive and effective team. Number 5 is delegation, the act of assigning tasks or responsibilities to others. Number 6 is problem solving, which is the ability to identify solutions to challenges or issues. Number 7 is time management or prioritization, the skill of organizing tasks based on importance and managing time efficiently. Number 8 is self-confidence, belief in one's own ability and judgment. Number 9 is resourcefulness, the ability to find quick and clever solutions using available resources. Number 10 is innovation, the creation of new ideas, products, or methods to improve processes or meet needs. Number 11 is taking initiative, which is the ability to act independently and start tasks without being asked. Number 12 is taking calculated risks, making decisions based on a careful evaluation of potential outcomes. Number 13, taking responsibility, accepting accountability for one's actions and decisions. Number 14, motivation or determination to succeed, which is basically the drive to achieve the goals despite the hurdles and challenges that come in the way. Number 15 is creativity, the ability to think of new original ideas or solutions. Number 16 is perseverance, continuing to work towards a goal despite obstacles or setbacks. These are the 16 enterprising skills that an entrepreneur must have in order to create a successful enterprise. The most common skills asked about in the question paper is taking calculated risks, problem solving, and taking initiative. It is important for you to know how you applied some of these skills in your enterprise project because that is a question that is asked in section B. Next, how entrepreneurs use their enterprise skills. Doing a quick Google search is going to help you find out that these are the top 3 most successful entrepreneurs. Now, I won't be reading all of this, but this is just here as an example because a question might come up where they ask you to name an entrepreneur and how their enterprising skills led their enterprise to become successful. That is a question that has come up very recently in the 2025 May-June series. Feel free to pause the video and just read these so that you get a clear idea of how you're supposed to answer a question like that. Unit 4, Enterprise Opportunities, Risk, Legal Obligations, and Ethical Considerations. This is a relatively long chapter, so let's get right into it. So what are opportunities? Opportunities are situations or events that make it possible to do something. In business, an opportunity is a set of circumstances that allows for achieving a goal, creating value, or making progress. So, how do opportunities emerge? First, through changing needs and wants. As people's lifestyles, preferences, and incomes change, new demands appear. For example, changes in fashion have increased demand for sustainable clothing. An aging population creates more demand for healthcare products and services, and higher incomes often lead to greater demand for luxury goods. Second, the change in the ability to meet needs or wants. When factors like resources, skills, or technology change, it becomes easier to meet previously unmet needs. Third, through advances in technology. Technology often creates brand new opportunities. The internet has led to the growth of e-commerce. Improvements in battery technology made electrical vehicles possible. And artificial intelligence is driving innovation across many industries. Fourth, through changes in government policy. When governments change laws or introduce new policies, new markets can open. For instance, grants and subsidies encourage renewable energy businesses. Tax breaks support the growth of tech startups, and stricter environmental laws create opportunities for eco-friendly products and services. In summary, opportunities emerge from changes in society, technology, and government. Now, let's talk about risk. Risk is the chance of gaining or losing something because of an action taken. In enterprise, risk is unavoidable. Now, let's discuss the types of risks. There are 5 types of risks that are listed in the syllabus. Of course, there are more types of risks, but you don't have to know them. Number 1 is financial risks. Financial risks arise from insufficient financial resources. For example, not having enough finance can limit growth and affect day-to-day operations. Number 2 is economic risks. Economic risks come from changes in the economy, such as income levels, taxes, or inflation. For instance, changes in taxation may force businesses to adjust pricing or costs. Number 3, health, safety, and environmental risk. Health, safety, and environmental risks involve accidents, health hazards, or damage to the environment. For example, stricter workplace safety laws or environmental regulations can directly impact operations. Number 4 are production risks. Production risks relate to the resources and equipment needed for production. A shortage of materials or malfunctioning machinery can disrupt business activities. Number 5 is human resource risks. Human resource risks concern managing people, recruitment, and legal compliance. For example, high staff turnover or disputes over labor laws can reduce productivity. Going more in depth, these are the stages to risk management. Number 1 is identifying the risk, then analyzing its implications, and then deciding if the risk is worth taking. If the risk is not worth taking, then you don't take the risk. But if the risk is worth taking, then you plan how you're going to manage that risk. Let's look at each step in more depth. Step 1 is identifying the risks. This is done using tools like a SWOT analysis or a pest analysis. It is important for you to know what a SWOT analysis is more than a pest analysis because you are going to be conducting a SWOT analysis for your enterprise project. A SWOT analysis is more of an internal analysis and is more related to the activities of the enterprise. A pest analysis is an external analysis, which is related to the environment that the enterprise is in. So a SWOT analysis stands for strengths, weaknesses, opportunities, and threats. So a SWOT analysis is basically going to make you write down what are the strengths of your enterprise, what are the weaknesses of your enterprise, what opportunities emerge from your specific enterprise, and what are the threats that your enterprise has to face. By highlighting weaknesses and threats, SWOT helps businesses spot risks inside and outside of the organization. For example, outdated technology is a risk. A pest analysis, like I said before, examines external influences. So PEST stands for political, economical, social, and technological. PEST analysis is going to examine the political factors that affect your enterprise, the economic factors that affect your enterprise, the social factors that affect your enterprise, and the technological factors that affect your enterprise. PEST analysis helps identify risks that come from the wider environment. For instance, inflation may increase costs, or new regulations may require expensive changes in production. Together, SWOT and PEST provide a complete picture of where risks may come from, making it easier to prepare for and manage them. Step 2 is analyze the implications. This is where you weigh the potential negative outcomes against the potential rewards. Step 3 is deciding if the risk is worth taking or not. Consider whether the potential benefits outweigh the possible losses. Then, once you decide that the risk is worth taking, you move on to step 4. Planning on how to manage the risk. There are 4 main ways on how you can manage the risk. Number 1 is mitigating the risk through research, advice, and planning. Number 2 is accepting the risk when it cannot be reduced further. Number 3 is transferring the risk to another party, such as through insurance. For example, a business can buy insurance so that if something goes wrong, the insurance company covers the losses instead of the business. And number 4 is eliminating the risk by not taking it at all. Now let's discuss the 3 attitudes that entrepreneurs have towards risk. Number 1 is risk averse. These are individuals who avoid risks whenever possible. Number 2 is risk reducers. These are the type of people that try to minimize the risks as much as possible so that the likelihood of success is higher. Number 3 is risk keen. These are individuals who are willing to take on all risks. These attitudes shape entrepreneurial decision-making. Risk-averse entrepreneurs often prefer stability, while risk-keen ones pursue rapid growth. Risk reducers aim for balance, minimizing losses while still seeking opportunities. Now let's discuss legal obligations. When you see the word laws, don't worry. You will not be questioned on specific laws in your exam. Every enterprise must operate within the framework of the law. Legal obligations provide the rules and the standards that business must follow to ensure fairness, safety, and accountability. These laws protect not only the business itself, but also employees, customers, and the wider economy. Number 1 are employment laws. Employment laws exist to protect employees. They ensure fair wages, safe working conditions, and equal opportunities without discrimination. They also provide entitlements such as maternity and paternity leave, as well as paid holidays. Number 2 are production laws. Production laws regulate safety, quality standards, and environmental protection. businesses must ensure that their products are safe to use and that their operations do not harm the environment. Number 3, marketing and selling laws. These laws prevent false advertising, misleading claims, and unfair competition. Businesses must be transparent and truthful in how they market products or services. This allows consumers to receive accurate information and to make informed decisions, while fair competition supports innovation and market growth. Number 4 are finance laws. Finance laws require businesses to operate with transparency and accountability. They also prevent financial fraud and unethical accounting practices. This means that investors, creditors, and consumers benefit from the market stability and increased confidence in the enterprise. Take a moment to pause and read all of these yourself so that you get a clear idea of what legal obligations are, and so you understand the general knowledge behind the 4 laws that are included in your syllabus. Next, let's talk about ethical considerations. Beyond the law, businesses must also act ethically to create a positive impact on society and the environment. Now, ethical considerations cannot be enforced, but are good practices that are a projection of the entrepreneur's morals. The table on the left shows how the consideration of enterprises can negatively and positively impact societies. Now, ethical practices within the enterprise itself means acting with integrity and embedding values into business operations. Fair trade ensures that producers, especially in developing countries, receive fair pay and work under ethical conditions. Organic farming promotes environmentally sustainable farming methods free from harmful chemicals. Another example of ethical practices is charitable contributions, where enterprises can donate a portion of their profits to an important cause. In summary, ethical considerations go further, guiding enterprises to act responsibly, support their communities, and protect the environment. We are going to cover Unit 5, Negotiation. Before we begin, I'd like to start by saying that this topic may seem easy, but comes as 10 and even 15-mark questions in the exam paper, so make sure to listen attentively. Fortunately, this is a very short unit, so let's get right into it. So what is a negotiation? A negotiation is basically when 2 or more parties sit down and have a discussion to try and reach an agreement. That agreement could be about solving a problem, deciding on a course of action, or even bargaining for a better outcome. The key idea is that everyone involved should feel satisfied with the final result. Now, when discussing negotiation, you may hear the word compromise. Compromise basically means that one or more party involved gives up something to reach an agreement. For example, a supplier wants to sell raw materials for $1,000, but the buyer only wants to pay $800. Instead of walking away, they both compromise and agree on $900. The supplier still makes a profit and the buyer saves some money. Both sides give up a little, but they both gain something too. That's a compromise. Now we'll discuss the stages in the negotiation process. The first stage is planning. This is done before the negotiation takes place. The second stage is actually conducting the negotiation, and the third stage is measuring success. This occurs once the negotiation is over. Now let's look at each one of these stages in a bit more depth. The first stage is the planning stage. In no specific order, planning can include 1. Setting objectives, which means defining clear goals and targets that the proposal aims to achieve. 2. Choosing evidences to use, basically selecting relevant and reliable data or information to support the proposal. 3. Benefits of a proposal, highlighting the positive outcomes or advantages the proposal brings to the stakeholders. 4. Weaknesses of a proposal, which is identifying potential drawbacks or challenges that may arise from the proposal. 5. Arguments and counter-arguments. This is basically planning ahead of time of possible arguments that may arise and finding the right responses to each. The second stage is conducting the negotiation. Conducting a negotiation involves setting the tone, which means establishing a positive, respectful atmosphere to encourage open communication. 2. Presenting your proposal. Clearly explain your ideas, goals, and the benefits of your proposal. 3. Understanding each other's point of view. Actively listening to the other party's perspective and concern. 4. Summarizing to check understanding. Recapping key points to ensure both parties fully understand each other's position. 5. Reaching agreement. Finding a mutually acceptable solution or compromise that satisfies both parties. The third stage is measuring success. So how do you measure success? True success is when both sides achieve something positive, which is known as a win-win situation. Ask yourself what went well. Identifying the positive outcomes, achievements, and effective strategies that contributed to the success can help in future negotiations. What can I improve next time? Because every negotiation is also a learning opportunity. Reflecting on areas of growth, learning from challenges, and adjusting can lead to better results in future negotiations. Alright guys, that is the end of Unit 5. We are going to cover Unit 6, Finance. Let's begin. First, let's discuss the sources of finance. There are different ways to raise finance depending on the status of your business. First, let's look at the sources of finance for startup funding. So when starting a business, entrepreneurs need money, and there are a few common sources. First is personal savings. Using personal savings means you keep full control of your enterprise, no interest is involved, and you have quick access to the money, but the risk is high and funds are usually limited. Family and friends. The finance is easy to get, flexible with no interest involved, but if the business fails, it can strain the relationships. Bank overdrafts, loans, and mortgages. If you don't know what these terms are, I highly encourage you to do a little research and get a brief idea of what these are. Anyways, these are great for large funds, they're repayable over time, but you'll face interest and debt obligations. Community sources. Like charities or social enterprises, they may support local businesses, but usually the funding is small and comes with requirements. Grants and subsidies. These are fantastic because they don't need to be repaid, but applications are competitive and restrictive. Crowdfunding. You raise the money from the public online, it gives exposure and validates your idea, but there is no guarantee of success and it requires a lot of promotion. Lastly, selling shares. You can raise a lot of money without repayment, but you give up ownership and may face pressure from shareholders. Coming back to this, now let's discuss the sources of finance for funding or continuing trade and expansion. Once the business is running, entrepreneurs often need more money to grow. Number 1 is personal savings. Again, the same pros and same cons. Number 2, retained profits. Profits reinvested back into the business. It keeps ownership intact, but reduces cash available for other needs. Private institutions. They offer large funds and sometimes long-term support, but may require collateral or equity. Venture capital. Big money and guidance from investors, but they expect high returns and decision-making power. And lastly, issuing shares. This raises a lot of capital, no repayments required, but again, ownership is diluted and regulations increase. Now let's discuss the concept of trade credit. Another really common finance tool is trade credit. This is when a business buys goods or services now, but pays later. Trade credit is the overall system of buy now, pay later, and the payment is usually delayed for 30, 60, or 90 days. Trade receivables is the money that customers owe you, and trade payables is the money you owe suppliers. So it makes a lot of sense because trade receivables means something you have to receive, so it is the money that customers owe you, and trade payables means what you have to pay, so money you owe to the suppliers. First, we're going to discuss the pros and cons to the enterprise and the customers in the system of trade credit. From the entrepreneur's perspective, when they are the ones offering the trade credit system, which means they will be the ones expecting the trade receivables, the advantages include boosting sales, improving competitiveness, and building stronger customer relationships. However, the risks are bad debts, cash flow problems, and the need for strict credit control. From the perspective of the customers that are expected to pay off their debt to the entrepreneurs, the advantages are flexibility in managing cash flow, easier budgeting, and the ability to buy now and pay later. But the disadvantages are debt buildup, damage to credit rating, and possible late fees. Now this slide is very similar to the last one, except the entrepreneur has become the customer, so the pros and cons are pretty similar, so I don't want to go over them to waste your time, but feel free to pause and read through the slide right now. Moving forward, let's go through some key financial terms. Number 1, cash flow forecast. A cash flow forecast predicts future inflows and outflows. Number 2, break even. Break even is when the revenue, which is the money that you make, equals the costs of running the business. So this is the state when you're not in a profit or loss. Number 3, income statement. An income statement shows income, expenses, and profit or loss. Cash inflow. Cash inflow is the cash that is moving into the enterprise, whereas cash outflows is the cash that is moving out of the enterprise. Number 6, surplus. A surplus means that the cash inflows are higher than the cash outflows. whereas a deficit means the opposite. So the cash going out of the business is higher than the cash coming into the business. Number 8, variable costs. Variable costs are expenses that vary directly with the level of production or sales, such as raw materials, because the more sales that you make, the more material you'll need, so the cost isn't fixed. Whereas fixed costs are the opposite. They don't change, so they aren't dependent on something else. For example, rent. No matter how much you make that month or how many sales you make, whether it's 1 or 100, the rent of the equipment or the capital you're using is going to stay the same. Now, total cost is the summation of your fixed costs and the variable costs. Number 11, contribution. Contribution is the money that's left from the sales after paying off the variable costs. The money that is left over is then used to pay fixed costs, and whatever remains becomes profit. But there are 2 types of profits. Number 12, gross profit. Gross profit is the profit a company makes after subtracting the costs of goods sold from the revenue. Net profit. Net profit is the final profit after all expenses, including operating costs, taxes, and interests, are deducted. Number 14 are overheads. Overheads are ongoing costs that aren't linked to production. But I will say that this is a definition that you don't have to memorize. Now on this slide, I've listed the main formulas that you must know, so take a moment to note them down. Now let's discuss financial records in more detail. Financial records are essential because they show profit or loss, help manage cash flow, and provide legal and tax evidence. Income statements summarize financial performance and help assess profitability. Budgets plan income and expenses, helping to control spending and set goals. Cash flow forecasts predict shortages or surpluses, making sure the business can pay its obligations. This slide is very important because it covers all 3 financial documents that the syllabus requires you to know about. But how do you make an income statement, budget, or cash flow forecast? First, let's see how to create a budget. To create a budget, first list all your income sources. Then categorize your expenses into fixed and variable. Next, set limits for each category. And finally, track actual income and expenses against your plan. Number 2, how to create an income statement. An income statement starts with a total income. Then subtract expenses such as rent and salaries. What remains is profit or loss. Finally, adjust for taxes if needed. Number 3, how to create a cash flow forecast. To prepare a cash flow forecast, start by estimating inflows such as sales or loans. Then estimate outflows like rent or salaries. Add your opening balance, subtract outflows from inflows, and you'll find the closing balance. You have to review a cash flow forecast regularly to keep it accurate. Keep in mind, from my knowledge, I haven't seen a question paper that has asked you to prepare an income statement, budget, or cash flow forecast. However, the syllabus has required you to know how to make these and know the purpose and importance of each. We are going to go through Unit 7, Business Planning. Before we begin, I'd like to start by saying that this is a very important unit and is very common in Section B of your question paper, meaning it usually comes as 10 or 15 mark questions, so make sure to listen carefully. Anyways, let's get right into it. First, let's go over aims, objectives, and their differences. Aims are broad, long-term goals that give a business overall direction and purpose. They guide decision-making, motivate people, and help align strategies with the bigger vision. Objectives, on the other hand, are different. They are specific, measurable, short-term targets that break down aims into practical steps. Objectives allow progress to be measured, make planning and resource allocation easier, and enable monitoring and evaluation of performance. In short, aims set the vision while objectives provide the actionable steps to reach that vision. For example, a bakery's aim might be to become the most popular bakery in the city. Using this aim as the vision, the bakery's objectives could be to increase sales by 20% within the next year, or to open 2 new branches in the next 3 years. Next, action plans. An action plan is a detailed outline of what needs to be done to achieve a goal or objective. Its purpose is to provide a clear roadmap, break tasks into smaller steps, and assign responsibilities and timelines. The importance of an action plan is that it keeps efforts focused and organized, increases accountability, and raises the chances of success. The main contents of an action plan includes goals, tasks, responsibilities, deadline, resources, and metrics. Action plans also need to be monitored. This can be done through regular check-ins, progress reports, performance metrics, etc. And they must be updated when circumstances change, when new information becomes available, or to improve performance. Updates also happen once goals are achieved, so the plan can move forward to new objectives. Lastly, before we move on to business plans, I just want to say that you will be required to make an action plan for your enterprise coursework. So applying this knowledge will help you when you're working on your enterprise project. Alright, business plans. A business plan is a comprehensive document that sets out a business's goals, strategies, market analysis, and financial projections. It acts as both a guide for decision making and a tool to attract investors. The purpose of a business plan is to provide a roadmap, support resource allocation, and secure funding. Its importance is that it clarifies the vision, helps identify risks and challenges, and serves as a reference point for measuring performance. The typical contents of a business plan are already listed on the screen, so make sure to read through those. Next is monitoring a business plan. Monitoring a business plan is done through regular progress reviews, financial tracking such as income and expenses, feedback loops, and market monitoring. Finally, business plans must be updated. This happens when the market conditions change, when milestones are reached, to improve strategies, to meet investor expectations, or when there are internal changes within the business. This is why it is so important to update your action plan or business plan, because of the constant changes that appear in an enterprise, and to make sure that they are up to date. Before we begin, I'd like to start by saying that this is a very important unit and is very common in section A of your question paper. Anyways, let's get right into it. Alright, so first we're going to go over market research. Market research is the process of gathering, analyzing, and interpreting data about a market. This includes collecting information about the target audience, customers, competitors, and the overall industry. The purpose of market research is to understand customer needs, preferences, and behaviors. It also helps businesses identify market trends and opportunities, measure how effective their current marketing strategies are, and make more informed decisions while reducing risks. Market research also allows businesses to track competitor activities and spot areas for improvement. Potential customers. Potential customers are individuals or organizations that have the need, desire, and financial capacity to purchase a product or service, but they have not done so yet. There are several methods businesses can use to identify potential customers. The first is market research, which is useful for all types of enterprises, especially new businesses. Market research gives insights into customer needs, market trends, and demand. The second method is social media analytics. This is effective for business to consumer, otherwise known as B2C enterprises, like fashion, food, or technology. It helps reach a wide audience and makes it possible to use targeted advertising. The third method is competitor analysis, which is the most useful for established businesses or those in competitive markets. By studying competitors, businesses can identify market gaps and new opportunities for differentiation. The fourth method is networking and referrals. This is particularly effective for small businesses, startups, and service-based enterprises. It builds trust through personal connections and word-of-mouth recommendations. And finally, website analytics. This is best for e-commerce and online-based businesses. It allows businesses to study user behavior and optimize their marketing and sales strategies. Going deeper into market research, there are two main types of market research: primary market research and secondary market research. Primary market research is the collection of original data directly from the source, usually customers. This is done through surveys, interviews, or observations. The advantages of primary research are that it is specific to the business's needs, gives more control over data quality, and provides up-to-date information. However, the disadvantages are that it can be time-consuming, expensive, and sometimes only uses a limited sample size. Secondary research involves analyzing existing data that has already been collected by others. This includes industry reports, academic papers, or government statistics. The advantages are that it is quick to access, low in cost, and usually provides large data sets. The disadvantages are that it may not be specific to the business, and it can sometimes be outdated or lack accuracy. Now let's go more in depth into market research methods. For primary market research, the most common ways are surveys, interviews, focus groups, and observations. Whereas for secondary market research, the most common ways are reviewing academic papers and government statistics. Surveys are customizable and can reach a wide audience. They provide quantifiable data that is easy to compare. However, surveys may suffer from response bias, can be time-consuming to analyze, and can also be costly. Interviews provide in-depth insights, high-quality data, and personalized answers. But interviews take time. They can be expensive, and they require skilled interviewers to be effective. Focus groups provide rich qualitative data because they allow direct interaction with customers. They are also flexible in how they are run, but the sample size is small. There is a risk of groupthink where participants influence each other and the results are often harder to analyze. Observations give real-time data, show natural customer behavior, and avoid bias from people's answers. But observations can be subjective, limited to a specific environment, and often time-consuming. Academic papers provide reliable data and in-depth analysis. They give access to research that has already been carefully reviewed. However, they can be complex to interpret, not always up-to-date, and may not be industry-specific. Government statistics are usually free or low-cost, reliable, and widely recognized, but they may not cover niche markets, are limited to publicly available data, and can sometimes be too broad. Okay, market research is over. Now we'll move on to the next topic, customer retention. Customer retention is the strategies a business uses to keep its existing customers and encourage them to buy again. Retaining customers helps to build brand loyalty, defend market share, and improve sales and profit. There are several methods to measure customer satisfaction and retention. Businesses can measure the number of sales and complaints, use mystery shopper feedback, run questionnaires, or conduct focus groups. There are also several ways to retain existing customers. Businesses can provide effective customer service, have a system for resolving complaints, offer loyalty rewards, and develop new products and services to keep customers engaged. Now, marketing communication. When you see this table, don't get scared. We're going to go over all of them one by one and break them down so it is easy for you to understand. Marketing communication is how a business promotes its products or services to customers. Each method has its own costs, availability, and suitability. Number 1, television advertising. Television advertising has a wide range and short visual impact, and it helps build brand awareness. But it is very expensive, exposure time is short, and it may not target specific groups effectively. Radio advertising. Radio advertising is more cost-effective than TV advertising, works well for local markets, and allows frequent repetition. But it has no visuals, limited targeting, and people may not pay attention if they are doing other activities. Plus, not many people listen to the radio nowadays either. Cinema advertising. Cinema advertising has strong visual and sound impact and reaches a captive audience. However, it is costly to reach large numbers of people, limited to those who attend cinemas, and exposure is short. Newspaper and magazines. Newspaper and magazines have credibility, target specific demographics or regions, and magazines can last a long time, but readership is declining. The reach can be limited, and national publications can be expensive. Posters. Posters are low cost, widely available, and highly visible in busy areas. However, they only give limited information, they are short term, and it's difficult to measure their effectiveness. Leaflets. Leaflets are also low cost, customizable, and can be distributed directly to the target audience. But many people see them as junk mail, exposure is limited, and they are not suitable for all businesses. Online communication and social media. Online communication and social media have a global reach, allow highly targeted ads, and are interactive and cost-effective. But they require constant monitoring, can lead to ad fatigue, and are time-consuming. Word of mouth and announcements. Word of mouth and announcements are free, build trust, and are effective for local businesses. However, they are difficult to control, hard to measure, and rely completely on customer satisfaction. Finally, sponsorships. Sponsorships create positive brand associations, give targeted exposure, and can provide long-term visibility. But sponsorship is expensive. Businesses have little control over the content, and it may not directly increase sales. Help and support. There are two main types of sources for help and support: formal and informal. Formal sources are structured and regulated organizations or individuals that provide professional assistance and services to businesses. These include government and business agencies, consultants, financial institutions, charities, teachers, business networks, and other entrepreneurs. Let's go through each one. Government and business agencies. Government and business agencies are the best for businesses that need financial support, help with compliance, or regulatory guidance. For example, they might provide grants, trainings, or advice on meeting legal requirements. Consultants. Consultants are ideal when a business requires specialized expertise or strategic advice. This could be in areas like finance, marketing, or operations. Consultants bring professional knowledge and external perspectives. Financial institutions. Financial institutions are essential for businesses that need funding or financial planning advice. This could be banks providing loans or guidance on managing accounts. Financial institutions support both startups and established businesses. Charities. Charities are particularly suitable for nonprofits, social enterprises, or businesses focused on community impact. They may provide funding, resources, or training tailored for organizations with social goals. Teachers. Teachers are helpful for startup and small businesses because they provide foundational knowledge, education, and personal development. They are especially important when entrepreneurs are still learning about business. Business networks. Business networks are perfect for businesses looking to expand, build partnerships, or gain visibility within their industry. Networks connect entrepreneurs to potential clients, suppliers, or collaborators. Other entrepreneurs. Other entrepreneurs can be a valuable source of mentorship, collaboration, and real-world insights. Experienced business owners often share lessons they've learned from their own journeys. Now, informal sources of help and support. Informal sources are personal connections that provide advice and encouragement. They are not professional services, but they can be just as important. These include friends, peers, and family. Friends and peers are suitable for offering emotional support and practical advice because they often understand the challenges of entrepreneurship. They can provide encouragement and share personal experiences. Family. Family can also play a key role. They might provide financial support, encouragement, and advice based on trust and their own experiences. Having supportive family members can help entrepreneurs stay motivated and confident. I've listed the suitability for each source in this slide so that it's easy for you to note down. Anyways, in summary, entrepreneurs can receive support from both formal and informal sources. Formal sources provide structured professional assistance such as finance, training, and strategic advice, while informal sources provide encouragement, practical tips, and sometimes even financial help. That brings us to the end of Unit 9, Unit 10, Communication. Let's get right into it. First, let's go over methods of communication. It is important to note that I've put these up here so that you have a clear idea of what we're talking about when we say communication. This is not some official list from your syllabus exactly. Anyways, there are many ways businesses can communicate. These include emails, business meetings, reports, memos, phone calls, social media, text messages, etc. All these methods can be formal or informal depending on the audience. For example, an email to a customer may be written in a formal style, where an email to a colleague may be written in an informal style. The key is that the method and the style of communication depends on the audience and the purpose. Language changes depending on whether communication is formal or informal. Formal communication uses proper grammar and professional vocabulary. Sentences are complete and structured, and it avoids slang or overly casual expressions. The tone is respectful, neutral, and clear. Informal communication is different. It uses simpler language, sometimes slang or colloquial terms, and shorter sentences. The tone is relaxed, friendly, and sometimes even humorous. So why does our language change? It depends on two things: the audience and the context. For professional, academic, or official audiences, formal language is required. For family, friends, or close colleagues, informal language is acceptable. In serious or important situations, formal communication ensures clarity, professionalism, while informal language is more suitable for casual conversations or social settings. Now, communication is not only about words. Body language also plays a big role. Non-verbal cues can show emotions, often more strongly than words. Positive body language, like open posture or smiling, helps build trust and connection. Negative body language, like crossed arms, can create confusion or distance. Body language supports the message being spoken. It makes communication clearer, shows professionalism, and helps strengthen relationships. Appropriate communication methods with stakeholders. I want you to recall what we discussed back in Unit 1 about stakeholders. There are two different types of stakeholders, internal and external. Different stakeholders require different methods of communication. For internal stakeholders, managers are best communicated through formal meetings, reports, emails, or video calls. Employees can be reached through internal emails, team meetings, notice boards. Shareholders usually receive annual reports, financial statements, or shareholder meetings, while owners may prefer formal meetings, financial reports, and sometimes direct emails or phone calls. For external stakeholders, suppliers communicate through emails, phone calls, formal contracts, and meetings. Customers can be reached through social media, customer service calls, emails, and surveys. Banks require formal letters, financial reports, etc. The local community may receive information through public announcements or social media. Local government is usually contacted with formal letters, reports, meetings, and emails. Choosing the right method for each stakeholder ensures the message is received clearly and professionally. Meetings and presentations. This is the 3-step process for successful meetings and presentations. Number 1 is the planning stage. Number 2 is providing documents related to the meeting. And number 3 is evaluation. Number 1 is the need for careful planning. Careful planning is essential for meetings and presentations. Before the event, planning ensures that goals are clear, resources are in place, and potential risks are identified. It sets expectations and prepares the team for challenges. During the event, planning allows smooth execution, flexibility in handling issues, and effective monitoring of progress. It keeps everything on track and helps achieve objectives. After the event, planning provides a framework for evaluation. It allows the team to learn from outcomes, assess successes, and identify areas for improvement. Number 2, importance of providing documents. Meetings and presentations should also be supported by documents. The importance of these documents is that they ensure clear communication, provide a formal record of discussions, support decision making, demonstrate professionalism, and keep participants engaged. For meetings, documents include a notice of meeting, the agenda, and minutes. For presentations, documents include visual aids such as slides and handouts for the audience. Finally, meetings and presentations should be analyzed and evaluated. When analyzing decisions, businesses check if the decisions made align with the goals and whether they address key issues. When assessing objectives, businesses look at whether the meeting or presentation achieved its purpose. This ensures that time and resources were used effectively and improvements can be made in the future. And that brings us to the end of Unit 10. But not only Unit 10, this is also the end of your IGCSE Enterprise syllabus. If this video helped, make sure to subscribe, and that's all for today.